Let's now discuss some unique accounting and reporting issues for healthcare organizations, and also discuss journalizing the transactions and preparing the basic financial statements for a not-for-profit healthcare organization. So let's start off by saying that, of course, we are becoming more and more aware of just how complicated our healthcare system is, not only in what we are seeing in this particular class and this chapter, but also as discussed on the news. We've had lots of government involvement over the last several years. Of course, it's going to be complicated because not only do we have the service providers, and we had a lengthy list that we went over in a video segment or so ago. Not only do we have all those healthcare entities, but we also have state and local welfare agencies. We have Medicare, and we have Medicaid, and we have all those insurance companies that are involved in all of this. Blue Cross Blue Shield, Cigna, lots of other ones out there. But we have the employers too, and the employees. Now I want you to know this for sure, that when it comes down to employers purchasing the insurance coverage, that I can promise you they negotiate the rates, because this has been my background as a former business owner. We had to continuously every year go through negotiating with the different healthcare companies out there, and you didn't always re-enroll with the same one as last year. So you negotiate with the different companies, the terms, the conditions, which plan offerings, what the pricing is going to be. All right, so we've got those employers involved. Of course, the employees are worried about how much is going to be their portion if their employer doesn't cover all of the health care benefit. Both what's going to have to come out of their paycheck, but then also what's the employee going to have to pay in order to meet their deductible. And then we've got those folks that may not be able to afford insurance at all. All right, so then they've got a penalty now with the IRS for that. And then we also have people who need care who don't have insurance and they can't afford to pay. All right, so it's very complicated. Luckily, we do have some grants that get given. We have contributions given. So let's think of who all these users are of the financial information that's being put together. So not only do we have hospital management and grantors and contributors, patients and employers, the healthcare insurance companies, but who else do we have? We have regulators involved. We even have licensing that's required for these facilities. We have creditors who are loaning these organizations money. We also have creditors for things like accounts payable and things like that. So think of the broad set of users that's using all this information that's being put together. Now, when it comes down to it, again, these contracts for the amounts that are going to be paid by the third-party payers, it comes down a lot to negotiations. So I don't know what elective courses you guys have available to you outside of accounting, but I would highly recommend a negotiation class if we happen to have one. When these contracts are negotiated, many times they talk about the allowed procedures. All right, so what is the coverage? What things are covered? Because not everything's covered. We would hope everything's covered, but not everything's covered. And then how is the insurance or other party supposed to pay? What's the amount? All right, sometimes it could be based on allowed cost. Many times within the contracts, they come up with a predetermined contracted rate. Sometimes it can be for a service. Sometimes it can be just a particular flat amount for the period. All right, so there's all kinds of complicated things going on as far as rates go, but many of them may be cost-based. So keeping up with the cost of services provided is a very important thing when it comes to healthcare. So if any of you guys have an interest at all in accounting for a healthcare organization, boy, now is the time to get into that, in my opinion, because again, we've got the baby boomers that are all retiring out. Many of them are, getting at the age where they're starting to have more and more health problems. All right, so that means there's going to be an abundance of patients and an abundance of accounting needing to be taken care of. Healthcare systems are using sophisticated systems to track all of the costs. So if you were to take this class and a cost accounting class, especially the ACC 4060 Advanced Managerial course, and think of it from a healthcare perspective, you guys could probably name your price for your future salary, depending on how well you're able to use your skills. Something else I would mention here is there's a push, especially locally, but not just locally, literally it's probably all around the world, in regards to lean healthcare. All right, so again, if you guys are interested in a career in healthcare and using your accounting, look into lean healthcare. I was literally in a meeting about lean healthcare probably about 2 months ago, and there is definitely potential in that particular area. All right, so let's talk about the reporting that we're going to be providing. All right, so we have said we've got FASB is going to have our guidance for our non-governmental, not-for-profits, and our for-profits, where our GASB is going to have our oversight for the governmental healthcare entities. All right, so let's talk about the FASB, non-governmental, not-for-profits, and the for-profits for a few minutes. With their balance sheet, we're basically referring to it as our statement of financial position. We've got a statement of operations. It's a lot like our income statement. We have a statement of cash flows and a statement of changes in net assets. With our statement of operations, we need to break it down into operating and non-operating activities, or earned and unearned, or recurring and non-recurring. Again, what are we doing here? When we look at a statement of operations, don't we want to see how well the entity performed for a period of time? Absolutely. And we want to know what is their main bread and butter activities of the organization, the operating activities, not the non-operating activities. So we kind of need to draw a line, and we want to look at the operating activities and see how well they performed, and then we can consider the non-operating activities as well, but the operating is the most important part. So it's very important to have a way for users to be able to see the performance. So a performance indicator to report the operating results, basically like what we would see for a financial accounting perspective of a regular business entity. Something comparable to income from continuing operations. So we could look at it like this: revenues plus gains plus other support without donor restrictions minus expenses and plus other income. We could also put plus investment income that's unrestricted plus realized gains minus any realized losses and plus any unrealized gains on trading debt securities, or minus the losses on trading debt securities. That would show us what our income from operations would look like. Now, with our statement of operations, when we look at the GASB for the governmental, they're very similar to a statement of revenues, expenses, and changes in net assets. For the governmental one, is a lot like our statement of operations. For our FASB, continuing on, non-governmental, not-for-profit, and for-profit, the statement of changes in net assets, it can be combined with our statement of operations, but typically it's separate because it is good to see the operating activity separate from investment and other activity. With our GASB governmental, they only have 3 required reports. They've got the statement of net position, they've got the statement of revenues, expenses, and changes, and the statement of cash flows. The governmental healthcare entities do not have to have the statement of changes in net assets. They don't have a statement that's comparable to that one for the non-governmental, not-for-profit. All right. Things that are unique. Charities. Now, we're talking about governmental and not-for-profit healthcare entities specifically. So our for-profit healthcare entities are not required to provide charity, even though some of them probably do. But our governmental and not-for-profit healthcare entities are expected to provide some level of charity care. All right, so the governmental healthcare entities, some are required to do it by law. And then think about it. The not-for-profit ones, they're designated as not-for-profit based on the fact they applied with the IRS to get that status. And in order to get that status, recall that we had to disclose there what was the goal and the objective and who were the beneficiary recipients. All right, so to get the not-for-profit status, then there had to be some charity going on there, and that's why these organizations are held to the line. All right, so they must provide some level of charity care. Now, when the services are rendered to the people who have no ability to pay, again, these are our charity receiving patients, the entities do not record a revenue and an accounts receivable because it's already deemed as a charity case. They also don't, put in an expense to bad debt expense for that either. All right, we're not writing it off because we never recognized it as a revenue to begin with. Now, it's very important that the entities disclose their policies regarding their charity care and the amount of provision of the charity care. It all should be disclosed. Now, think about it. Some third-party payers, like insurance companies, may actually have it in their contract with the facilities to reimburse them for some part of bad debt expense. And charity care is not recorded as a revenue and then written off to bad debt expense, because that's not how it works. If the organization happens to receive grants or gifts in order to help the entity cover or pay for the cost to provide charity care, then that needs to be disclosed separately. Oh, I failed to mention, or at least I think I did. All healthcare providers use accrual basis of accounting. Okay, they do accrue expenses, and when they go about reporting the expenses, they're either going to break them down as a functional type or natural presentation. A natural presentation is basically like what you guys learned about in your financial accounting courses. So selling and admin expenses, utilities expenses, yada yada. Functional, we could break it down by maybe the type of service area that incurred that type of expense. Now, with our receivables and revenues, again, think of who the users are, looking at all these reports. And we've got all these complex calculations that go into how the invoices are invoiced, how much is going to be collected. A lot of it is based on rates negotiated, but also coding that is done. So sometimes you guys may read job postings and it talks about the healthcare coding. So they literally have a numbering system for procedures that are performed on patients. Some of these are bundled, some of them are unbundled, etc. It gets a little intense in regards to all of how this is done. But when we have patient revenue, we're basically just crediting patient revenues, right? And debiting receivable. Well, what about our allowance for uncollectible accounts? We will credit allowance for uncollectible accounts when we are establishing an amount that we think we will not collect. Now, if you guys think back to Principles 1 and you guys learned the allowance method, think about it. What did you initially do when you estimated the amount not likely to be collected, and what you had to do was debit bad debt expense and credit allowance for doubtful accounts? Well, here in healthcare, what we do is we debit provision for bad debt. And provision for bad debt is actually a contra revenue account, not an expense account like bad debt expense was. So when we look at the operating statement for a not-for-profit entity and we see it says patient revenues reported at net, it's the patient revenues minus provision for bad debts, minus contractual adjustments. Now, what are contractual adjustments? Contractual adjustments have to do with the amounts that have been negotiated with the insurance companies, and the revenue might be billed out at what we think the service should be billed for, and then if we have a contract that has a set amount that needs to be paid at, then we will make a contractual adjustment. Other things about our revenues. Not only do we have the provision for bad debts and the contractual adjustments, but we may have other revenues. Other revenues, for example, could come from fees for cafeterias. All right, so think of all the food and beverages that are sold while patients are in the hospital. Their family members are hanging out with them while they recover. Hospitals may also have medical supplies and sales of those. They may have fees for education programs that they put on. They may rent out their facilities for certain things. They even have investment income and gains. They may have non-exchange or support revenue. For example, they can have revenues from contributions, and those contributions can be without donor restrictions. We can have grants coming in. We can have endowment income. The endowment income is typically restricted, right? But it could also be unrestricted. So again, we categorize these things so that when we put the financial statements together, we can tell the story. So as we record these items as they come in, keep in mind the end goal. What's the picture need to look like to tell the users what is happening? We can have prepaid plans. And prepaid plans are basically when the insurance carriers have negotiated with the hospitals and the employers have actually bought these plans, and the amounts paid can be based on a per case basis, a per service basis, per diem or per day. We can even have it per person, capitated, which means per head. All right, so when you guys have heard the term per capita, statistically speaking, and census results and stuff, per capita is per head. With these prepaid plans, we record the revenues at the time the agreements are made, not at the time the service is rendered. Now, we'll have costs incurred when the services are rendered, but at the point of the contract, the agreement, we would record those revenues. Now, these prepaid plans are kind of shifty, if you will, from the viewpoint of the healthcare entity, because these arrangements or contracts shift a considerable amount of risk to the healthcare organization, especially if it's just a flat amount per employee for a given period of time, because they're taking on the risk of something very bad going on with that employee and them having to provide the care irregardless of what the amount of the cost would be. So think about that. All right, with our payments that we may receive, we can receive interim payments during the period. And these are basically payments that are received during a period, and then later, once all the things have been processed, the insurance company will send the final settlement payment based on the terms of the contract with the healthcare provider. We may have settlement accounts being utilized during a period, and these are basically, we may show receivables or payables that arise from differences between the original invoiced amount. The original invoiced amount would be the original estimate of what the payment should be to be paid by the third-party payers. And then there's a difference because of what we expected is not going to be the same as the amount actually received, especially once the final determinations have been done. So there are some accounting mechanisms in there to try to keep everybody's books straight, if you will. Something else that is of interest is in regards to donated materials and donated services. Hospitals do receive donated materials or supplies. They even receive donated services. Now, for our entities that are overseen by FASB, again, these are our non-governmental, not-for-profits, and our for-profit healthcare organizations. When it comes to materials, per FASB guidance, we're going to recognize them at fair value, basically by debiting an expense account or possibly even a non-cash asset of some sort, and we would credit a revenue account showing that we received a contribution. And then as those would be used or consumed up during the provision of a service, then it would get costed out to that service provided. Think about it. We've said that hospital management needs to know their cost so that they can negotiate wisely with these insurance organizations. So if these items, these materials or supplies, and the next thing I'm going to talk about is services that have been donated, the hospital, if they have to pay for these things, if they didn't receive them as donations, we need to know our true cost of providing a service. So if we don't do this, then we don't have real numbers to work with. All right, so think about that. So we need to keep up with the cost, even if the item was donated to us. All right, so costs are needed for some reimbursements based on how an insurance or possibly Medicare or Medicaid is going to pay. We need to know the cost that we need to be reimbursed for. We also need it for pricing and contract negotiations. In regards to contributed services, we will record those at fair value if they create or enhance non-financial assets, or they require specialized skills, are provided by individuals possessing those skills, and typically would need to be purchased if not provided by donation. All right, let's see. When you guys look at the operating statement and consider our revenues and our expenses, I want you to be looking at our statement of changes. Let me find it here, an example here. Our statement of changes in net assets. You guys should take a second, pause the video, and go and look at the statement of changes in net assets. Because you're going to see that we have got the excess of revenues and gains over expenses and losses. And those are brought down from the statement of operations. If we have some assets that were released from restrictions, and I'm referring specifically to net assets, which you could also pause the video again and go look at a balance sheet. And if you look at the balance sheet, you will see that we have, let me find it here. We have our net assets section, and you should be looking at how that has without donor restrictions, undesignated, without donor restrictions, designated, with donor restrictions by specific use. Now think of how those kinds of things could have movement within them. And then go back and look at that statement of changes in net assets again. So if we've got some net assets that were released from restrictions, then we would add it to our excess of revenues and gains, if that's the case, over expenses and losses to get an increase in net assets without donor restrictions. And then look at our net assets with donor restrictions. During the period, contributions came in, investment income came in. You can see that there was an increase in provision for uncollectible pledges, and that is uncollectible pledges. So if someone made a promise to give a contribution of some sort, it's a pledge. And if there is any reason that we feel that it might not be coming in, for whatever reason, we would make a provision that that's not going to come in. Notice that we could have a loss on sale of investments. It's a subtracted amount also. And net assets released from restrictions. So notice it's a positive amount up above and a negative amount in the body. And then any contributions to permanent endowments would be a positive amount. And then we can calculate, do we have an increase in net assets with donor restrictions, or do we have a decrease in net assets with donor restrictions? And then you can calculate what is our net asset at the end of year, which of course is going to tie over to our balance sheet. So you have movement based on, do we have assets that are restricted, etc. So back to looking at the operating statement and what I was trying to get at. When we have revenues, we of course are crediting revenues accounts. We could have patient services revenues credited. We can have those other kinds of revenues credited. We can have contributions without donor restrictions coming in. We can have investment income without donor restrictions coming in. All of those got credited. Now, when we close them out, we would debit them at year end or period end. All right, so think about that. When we debit and close them out, what ends up happening after we close out expenses as well is what changed in net assets for the period. So expenses, what kind of expenses could we see? And I could change my slide here. With our expenses, we would have provision for bad debts, which is actually our contra revenue account that gets subtracted. Contractual adjustments, again, contra revenue account, it gets subtracted. Nursing service expenses, other professional expenses, general service expenses, administration, losses on disposal, those are just some examples. Those that were recorded with a debit initially get closed out with a credit. And then the debit to them is in essence making net assets go down. All right, so if you were to draw a T account for net assets without donor restrictions, undesignated, credits make it increase when we credit that account, or debits make it decrease. So what happened during the period? Were our revenues and gains greater than our losses and expenses kind of deal? If that's the case, then our net assets would increase. So keep that in mind, net assets. Now, if you'll go and look again at that balance sheet, you have net assets with donor restrictions and you have net assets without donor restrictions. And under the without donor restrictions, do you have it undesignated or designated? What about other types of revenues? Restricted revenues, for example, contributions with donor restrictions, investment income with donor restrictions. Now those, when we close out those revenue accounts, we close them with a debit because we would have recorded them with a credit initially. When we debit and close those, we will increase or credit net assets with donor restrictions. So again, if you draw a T account for these net assets, listed on the balance sheet, each individual one. When you close out the operating accounts, these net asset numbers are going to get changed based on what happened during the period. All right, so contributions without donor restrictions, investment income without donor restrictions, those two get closed out to net assets without donor restrictions. What about our assets that have been released for use? All right, so if we have some type of asset that had a specific donor restriction on it, and then it has been released for utilization, what you have to do is decrease where it was sitting. For example, T account. If you had an asset that had originally been recorded as a net asset with donor restriction, it would have a credit balance amount. And then if it's released for use, you would need to debit that same account to make it go down. So net assets with donor restrictions would be debited. And then because you released it, but it's still a net asset, you would need to credit net assets without donor restrictions, if that happens to be the case. So again, think about what you're doing. It's like reclassifying something. You're moving it from one area to another. You've got to decrease something and you've got to increase something else. Now, a moment about that. If you go and look at the balance sheet, you will see assets limited as to use. Now, assets limited as to use have not been limited by the donors and have not been limited by any grantors. They've been limited by management. Okay? Whereas if you look at net assets with donor restrictions, or even without donor restrictions, those are things that have come in from our other areas. So with donor restrictions is stating that they do have restrictions and it was by donors or by grantors. All right, in regards to our balance sheet, commitments and contingencies absolutely should be accrued if they can be reasonably estimated and they're probable. This includes such things as malpractice claims, any risk contracting, third-party payer payment program obligations to provide uncompensated care. Again, what did we say a few minutes ago about those prepaid plans? If we think we are going to have some commitments and contingencies there that are going to cost us, then we need to have it disclosed as a liability. We can have contractual agreements with physicians, as well as other types of commitments and contingencies. Now think about this. We don't just have commitments and contingencies only healthcare related. We can have other commitments and contingencies just like a regular business enterprise. Pension plans and things like that would also need to be disclosed. Something that's very interesting for healthcare is even unasserted claims should be accrued using industry best estimates. What are we saying here? What has been experienced for the industry for a given type of, let's just say, malpractice we haven't even had filed against us yet, but it's likely to happen. Then they would need to even put that in there, even if it's not been asserted by a lawyer yet, it would need to be included. With our balance sheet continued, Like we have seen, assets limited as to use. Limited as to use is basically saying as designated by the governing board of the organization or maybe by some type of contract or agreement with an outside party. We could have things like maybe they have planned for future use in some type of capital acquisition. Uh, the organization could even have self-insurance funding arrangements. They could, for example, have their own medical malpractice insurance. So instead of paying an insurance carrier to provide malpractice insurance and therefore indemnification in the event of a lawsuit, the organization can literally just pay it into a fund that they hang on to on their own. You could also even see statutory reserve requirements as required by some type of state law. We could see investments, and with those, we're typically looking at fair value. Now, keep in mind with the investor-owned healthcare entities, they do follow FASB guidance. And if you guys think back to intermediate class, you'll recall the trading, available for sale, and held to maturity and how that treatment works. In regards to our statement of cash flow, it's adjusted slightly for not-for-profits, and they can use the direct or indirect method. For our not-for-profits with the direct method used, they would need to show the reconciliation of changes in net assets to net changes provided by operating activities. The reconciliation, though, is not really required. We do have 3 sections, just like a typical statement of cash flows: operating, investing, and financing. Something to consider, though, those contributions without donor restrictions are actually inserted in the operating activities part. And then if we have contributions or investment income that have been restricted by donors for long-lived assets or endowments, then those we would put in the financing section inflows. So again, if we've got contributions without donor restrictions, we can put it in the operating. But if we have contributions that are restricted, then we put it in financing. Now let's talk just for a second or two about our GASB differences. Again, we're talking about governmental healthcare entities, and just a few things to highlight in regards to their assets. On their balance sheet, we show basically no assets limited as to use, but what we do show is restricted assets, those that are restricted by external parties. So we don't have assets limited as to use like we do with the non-profit and the for-profit healthcare entities. But with the governmental, we have restricted assets when we have assets that are restricted by external parties. For example, donors, per some type of contract or agreement with an external party, etc. With our governmental healthcare entities, we may have investments, and we would need to show those changes in fair value. And those changes in fair value would be reported in the statement of revenues, expenses, and changes in net position as part of our revenues or investment income. For our statement of cash flows for GASB directed healthcare entities, they would show the 4-section one like we've talked about in a prior chapter. So 4 sections, again, they're the operating, the non-capital financing, the capital and related financing, and then the investing section. And it is done via the direct method. So with the governmental, it is the direct method. Now, how they have it laid out for the non-capital financing, it would include unrestricted contributions in the non-capital financing instead of the operating section. And then for interest received would go in investing, which is not like we normally see, right? And then with non-capital financing and capital and related financing, we could see interest paid out there in one of those two areas, depending on what the original acquisition was for. And then acquisitions of land, building, and equipment, kind of like a business entity buying PPE. What would we do for a business entity on our 3 OIF, operating, investing, and financing regular statement of cash flows? Well, if it's a business one, an actual business for-profit entity, we would show acquisitions of land, building, and equipment as an outflow under investing, right? But not for the governmental healthcare entities. Acquisitions of land, building, and equipment needs to show up under capital and related financing. So it would show up as a use in that particular one. With these governmental entities, there is a required reconciliation. Again, because we originally do it in the direct method, then we have to reconcile it for those users to see the reconciliation of operating income to cash flows from operating activities. One last thing about the governmental that's a little bit different that I wanted to highlight, because I know there's a lot of stuff in this chapter, that the governmental entities under GASB do recognize and record when they have received donated materials or supplies, but currently do not do anything when they have been the recipient of some type of donated service. Now again, you guys, FASB is making all kinds of changes and GASB's right there with them. Depending on what you're doing in your future careers, make sure you try to stay up with the guidance and when deadlines occur and when things have to be put into place or implemented. Also, like I have mentioned before, if you are going to sit for the CPA exam, when you schedule your sitting, try to stay abreast of what guidance has been passed, when must it be implemented, and then when will it show up on the CPA exam. Now, hopefully there's some lag time there of at least 2 to 3 windows, but maybe not. So again, just be forewarned. One other thing I would mention about the CPA exam, if you are a Facebook user, I highly recommend that you guys go and check out this Facebook page called another71.com. And that's the word another, ANOTHER, 71.com. Go and read the about page about the guy whose business it is. But it literally took him 16 times total to pass all 4 parts of the CPA exam. But he's got a lot of good information regarding study habits, study content, and then it's a really good place to hear what other people say they have done and what works best for them when it comes to studying for the exam. And then you guys can always stop by my office if you want to talk more. I'd be more than happy to work with you.